I'm just looking for ways that we can make it easier on everyone. Because, we ultimately want to get to the same goal, which is that, everyone in this country can have a clean, affordable place to live and call home.
Welcome to the Built to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. And we believe that the key to scaling your wealth and compounding your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you create and preserve more wealth so you can give more, all of it away. Hey, I'm your host today, Brett Swartz. In each and every episode, we feature some of the world's best entrepreneurs, millionaires and billionaires, where they share their insights, wisdom, and secrets with us so we can scale together and we can give more, all of it away to help MVPs. So appreciate everyone out there who's listening today. I'm excited about our next guest. In fact, I met him in person for the first time at a major DLP event. Always honored to spend time with Don Winter and DLP. And I was at a couple-day conference, and I met this amazing gentleman who is going to talk to you about how to build wealth in hotel conversions to multifamily. Mm-hmm. He's out of the Northwest, and he is going to share with us today. Please welcome to the show with me, Ryan Sudeck. Ryan, how are you doing?
I'm doing fantastic, Brett. Thanks so much for having me.
Absolutely.
I can't believe we were in Asheville together right before that hurricane hit. It was like literally that week, right?
It was scary, man. I mean, we got out of there just in time. I don't know how you got out of there, but it was, a couple hours after the event ended, the next day is when it all everything hit the fan. And so it was pretty scary stuff, but fortunate to get out of there. We're praying that Asheville recovers. But, Ryan, diving right into a little bit of your story, it'd be great to have the listeners hear a little bit about your background and your story. And I know we talked about, Stanford and real estate and all these different things. So tell us a little bit more about you and what you're focused on and how you came to be there.
That sounds great. Well, again, thanks so much for having me. I'm going to back up a little bit further. So grew up on the East Coast, actually, in New Jersey. As you mentioned, I live just outside of Seattle now. But growing up in New Jersey as a kid, had a great childhood. My dad was actually a pilot by trade and had a small portfolio of real estate in our hometown. And so as a kid, I was swinging hammers, soldering pipes, installing toilets, snaking drains on the weekends, really just learning how to do real estate in a nitty-gritty way. Always did all the work ourselves and had a pretty formative experience that kind of put me on the path that I'm on post 9/11. So post 9/11, my dad was a pilot, as I mentioned. He lost his pension, took a 60% pay cut. And the only reason my parents were able to, kind of keep everything together was because of this, portfolio of real estate that they had. And so I knew that I wanted that insurance policy for my family one day. Fast forward, as you mentioned, I went to college out on the West Coast, went to Stanford, met my wife there. She's from the Northwest. That got us up here. Post-college, ended up going into mergers and acquisitions, so helping big companies buy smaller companies. Did that, kind of in financial technology, and then for a number of companies in-house, including Samsung and Amazon and Redfin, the real estate brokerage. Ended up spending the better part of 6 years at Redfin, helping not just acquire companies, but also form partnerships, start new businesses within Redfin. And in parallel, started acquiring multifamily properties and fixing them up like I wanted to do, and started with a 6-plex and then an 8-plex and a 16 unit and a 30 unit, kind of just having the 1031 exchange and snowballing effect of creating equity through the renovations. And the company that I run now is called Sage Investment Group. I'm now the CEO of Sage Investment Group. I joined about 18 months ago, even though we've been around since 2020. And when the company got formed in 2020 as an Evergreen fund, I moved the 2 properties that I had at the time into the fund in exchange for shares, and just became a passive investor and used this as, kind of my wealth generation tool in real estate. And, kind of privileged to be able to join the team about 18 months ago. And it's been a super fun ride, and we've got a really exciting 2025 ahead.
Absolutely. And this is the really cool part, that you're making exceptional returns in the multifamily world through the hotel conversion, which, quite frankly, I've seen and heard about since, 2010, but I hadn't seen and really people really executed at a high level. And I think this is the part where you guys have been able to figure that out. So let's dive right into this piece, Ryan. Like, what would you say is the number one secret to hotel conversions to multifamilies, not only making sense, but making these, healthy, solid profits?
I think the most important thing to understand is how hotels are fundamentally valued differently than multifamily properties. Some of your listeners might know what a cap rate is. Maybe to simplify it, we can talk about just a multiple of profits as a way to value a property. So if you look at a hotel, it'll be worth 3 to 5 times the profits that it generates, so the net operating income that it generates. Whereas a multifamily building is worth 7 to 12 times the profit that it generates. And investors are willing to pay more for that multifamily building because the occupancy is more stable. There's less expenses. You're not dealing with, changing sheets and linens and employing a whole staff. And so we're really capitalizing on a few things that exist in market. Certainly the fundamentals of that valuation difference allows us to capture a bit of an arbitrage. When we take that hotel asset and we convert it, the value increases. So that's how we generate, the investment return. On top of that, a lot of these hotels are in distress. Post-COVID, travel hasn't come back. So on top of being valued less on a multiple perspective, their businesses are struggling because of macro forces that are out there.
Okay, so this is key, right? So understanding fundamentally how they're valued, 3 to 5 profits for hotels, 7 to 12 for multifamily, and being able to understand that first piece. Okay, so then what's the second piece? To distress, right? And buying distress. What's the second piece to making this thing work? Because again, I've seen a lot of concepts or people who have business plans, but then they kind of fizzle out and they don't actually execute. You guys are doing this. Maybe bring it to life with a recent deal that you guys did, so we can kind of start to dive in.
Yeah, the most important thing is buying right, just like with any real estate deal. So we're acquiring these properties on a unit basis for anywhere from $25,000 per unit to, on the high end, $120,000 per unit. And once we do our development work, we're creating new units for about half of what it would take to build from scratch. And that's really, I'd say our secret sauce comes in 2 forms. One, it's just being patient buyers, not overpaying. And 2, the experience that we've gained over doing 22 of these projects now on the development side. We find that our costs to renovate on a per unit basis are about half of what our competitors are doing. That's because we value engineered each component, both the labor side, making sure that we're using the right labor for the right job. For example, you don't need a master electrician pulling out old wires, but you sure as heck need that master electrician hooking up the new wires. And then on the material sourcing, we're buying in bulk from India and China and direct from suppliers to save on materials costs now that we're doing this at scale. The other really important thing to know about this business model is, there is, a lot of permitting and zoning challenges to go through. We tried to do most of that before we buy the property, but ultimately we need the jurisdiction to allow for this commercial property that was functioning as a hotel to be a multifamily property. Okay, so this is key. All right, so
25 to 120,000 a unit, which is just incredible to think about. So when you guys are buying in distress or finding these opportunities, what you're saying is that's the beginning, but then you're going to add to it. You're either going to add more units. Obviously, you got to renovate the units. What is your average, all in unit cost before you're renting out?
Roughly 100,000. It varies on the market. On the low end, maybe 75,000. On the high end, 170,000. And that would be in a luxury market like Bellevue, Washington, where we're charging, where the rents there will be almost $1,900 per month. On the lower end, when we're producing units for $75,000 a door, the rents there are going to be, $850, $900 per month. And what we're creating ultimately is a naturally affordable housing unit. We're usually $300 to $500 less per month than the next cheapest thing down the street, the Class A that's just been built from the ground up. Our units are smaller, but they've got the full amenity package because we take all the hotel amenities and we repurpose them. We have a property in Olympia, Washington, for example, that has 16,000 square feet of conference space. Well, we don't need that as a multifamily building, but we put in indoor pickleball courts and a fitness center. And so really just trying to, add amenities that, keep our residents happy, help them form communities and relationships. And ultimately, that's great for their lifestyle. And it's also great for us and our investors because it means that our tenants stay longer in our properties.
100%. Pickleball is incredible, man. I fall in love with it. Not too many games beyond basketball that I fall in love with. Jiu-jitsu, pickleball.
Love it.
With my kids, it's Fortnite. I mean, those are like, the go-tos. So,
do you know it was actually started about like 30 miles west of me in Bainbridge Island, Washington, like a long time ago. It's funny how it's like had this resurgence, but it's actually the state sport for Washington, and it has been for like decades.
Wow. The things that you learn,
random
right?
fun fact.
Yeah, things that you learn. So this is really cool. All right, so let's keep diving in even more here. Right? So on average, $100,000 per unit.
Yeah.
You're renting around, what would you say? And give us some general returns that if someone put $1 million with you guys, what is it looking like right now as far as cash on average? What kind of multiplier are they looking at potentially? How many full cycle exits have you guys had?
Yeah. So all-in cost for $100,000. Usually those would be renting, call it for around $1,100 to $1,200 a month. In terms of the deal metrics that we're looking for a 30% deal level IRR or annualized return, and then net to LPs that's in the 25-ish% range, sometimes a little lower, sometimes a little higher. We're looking for at least an 8% cash on cash return. The way we raise our equity, though, is through an Evergreen fund. So folks who invest with us have the benefit of being in a diversified portfolio. And so the benefit that investors get is they get a quarterly distribution, which we've been paying for 4 straight years since we started. And our average annualized return is about 22%.
That's incredible so far, right? You guys are doing great. 2022, how many full cycle exits have you had to date?
We've had a number of full cycle exits in the fund that were value add multifamily before we fully committed to the hotel conversion space. Our first hotel conversion was in 2019. We ended up selling that in 2021. That was an $11.2 million basis that we sold for $18.9 million within 19 months. And we really fully committed to the hotel conversion strategy in 2022. We've only sold two hotel conversions out of the portfolio so far because our typical hold is 3 to 5 years, and we just haven't kind of come up on the business cycle yet. We've delivered a lot to market though in the last couple of years that have leased up just really, really fast because of this insatiable demand for naturally affordable housing.
Awesome. By the way, speak with Mr. Ryan, and you can learn more about his group by going to sageinvestment.com. That's sageinvestmentgroup.com. And they're focusing on solving the affordable housing crisis one hotel at a time. Over $295 million of assets under management, over 2,400 units. And they have expertise on this niche. And I think when you niche down, you can, the riches are in the niches, or I think the excess returns are in the niches, right? And again, I have not seen groups do this at a high level, and I really like the model because the basis is just so much more, just lower and less risk than just the pure development, right? It's so expensive to go ground up, and the time, opportunity, cost of money that sits in waiting for something to go ground up. It's already built. They come in. It's obviously more than just a renovation of something, right? It's definitely a heavier lift, but that also creates opportunity to do the full amenity packages and make these properties shine, and which means longer term you're going to be able to hold. Okay, so you buy well, you renovate well, you improve it well, right? And you're getting at a lower basis, and you're getting excellent returns, right? So talk to us about, maybe anything that I haven't asked so far about this, making money in hotel conversions to multifamily.
Yeah, there's certainly some challenges and pitfalls. We just started our 22nd hotel conversion project, and not one of them has gone perfect, right? There's always challenges that come up along the way. Each new cohort looks better than the rest, but there are a few things that we've learned along the way. One is, we want properties vacant. We don't have to deal with, hotel guests that don't leave, right? And then we have to evict them. Also, the permitting and zoning process just varies by each jurisdiction. And so, now we're just upfront with the sellers that we're working with just to say we're going to need 6 to 9 months to get that change of use permit, to get that building permit so that we can start construction on day one. Because the timeline, to your earlier point, right, ground up construction takes a long time. Our average renovation time is 6 to 12 months for these properties, and we're basically creating a brand new product. We're using the existing infrastructure, but sometimes we have to upgrade electrical and plumbing, but it lives like a brand new property when we're done with it. But the goal is to be very efficient with our time and our capital. So we want to start construction on day one. And so, we need to have those permits in hand before we'll close with our buyers now and, or with our sellers. And that's just something we've learned over time. One of the other thing that's been an unintended consequence of what we've done is just the community impact of taking over these largely derelict properties that have been sometimes riddled by crime. It's just transformational in some of the neighborhoods that we've gone into. For example, in Tacoma, Washington, which is a suburb just south of Seattle, we bought a series of 4 properties on one street called Hosmer Street. The Hosmer district of Tacoma accounted for 10% of the murders in Washington before we bought that property. It really just fell on hard times post-COVID. Since we purchased that property, violent crime has been eliminated in the neighborhood. Overall crime has dropped by over 60%. And just to maybe put a finer point on it, the police used to send 3 cops every time there was a service call or a 911 call at one of these properties. Now they send 1. And so this neighborhood has just been totally transformed. It's something that I didn't fully appreciate as an investor in Sage originally. And even when I first joined as CEO a year and a half ago, but it's just really cool to walk that street now and just see a vibrant and safe community. And we see this with other properties. We're certainly not seeking out, properties that are crime-ridden and trying to transform. It's definitely the byproduct, though, of the development work that we're doing.
Man, that's so cool. I love that you bring that impact into the conversation, right? It's the community impact that makes a difference. And you're right. Everyone knows that when they drive to downtown, there's certain areas or certain towns where you have that old hotel or motel that's not being taken care of, that does have, crime and things that could affect the neighborhood. And so if you can convert it to multifamily, people are going to live there versus just stay overnight or a weekend, it changes the entire dynamic and the nature of it. And now people, want a safe community that they live in, right? And so they're going to make sure to take care of the community. So that's phenomenal, Ryan. I love that. So okay. Now let's shift a little bit to opportunities that you're seeing now. Do you feel like 2025 is going to be more opportunities for more distress? What is your take on deal flow, interest rates, opportunities, any live deals right now that you want to talk about?
Yeah, deal flow is picking up, and it's because we've laid a lot of groundwork over the last few years, just going directly to sellers to talk to them. We're just very patient buyers. It takes us on average 18 months from when we start talking to a seller till when we end up buying a property. So in 2024, we purchased 7 properties. In 2025, it's looking like it'll be somewhere between 13 to 16 properties, kind of spaced out throughout the year. So we're definitely seeing a lot of opportunity. I think sellers are realizing that interest rates aren't going to drop dramatically, right? We're seeing where the 10-year has moved. The debts, interest costs are just a little stickier than sellers thought. And so we're the best buyer for most of these hotels. There's maybe one other thing that I touch on, Brett, just about the natural death cycle that happens with hotels. So, you kind of painted the picture. You can picture the hotel that was built in the 80s or 90s or 2000s. That's maybe fallen on hard times. Maybe a new property's moved in down the street, it's starting to suck away some of that business, and people are just staying down the street because it's new, right? When that happens, income drops for that hotel, And as a hotelier, the brand that you're flying, your flag with, whether it's Marriott or Hilton or, Wyndham, they have certain standards that they want you to keep, right? So if you go to a Residence Inn in any city, it's going to look very similar because Marriott says, hey, Residence Inn owner, you need to have this carpet and these countertops. Well, if you've fallen on hard times, you can't afford to make that capital investment. And so you might drop a tier. You might go from a Marriott down a tier. But it's kind of a slippery slope because the same business challenges exist, certainly from competition, like I mentioned earlier, but also post-COVID, we aren't traveling the same way that we were before. Airbnb's a thing. We're doing more destination traveling, less road trips. There's fewer business travelers out there. And so we just see so much natural opportunity because of this cycle that all these hotel properties go through.
Yeah, and in the meantime, multifamily is not changing. We were 5 to 7 million units short nationwide, and there's such a need for this. Okay, so let's talk about your fundamentals of your fund. You mentioned it before, Evergreen fund, right?
That's right.
Talk about a little bit of the preferred payout. Talk a little bit about the equity split. What does that look like? If someone had $1 million today and they're like, all right, Ryan, I like what you're doing. I like you guys' track record. I like what you guys are about, with the impact. All of it sounds really good. I have $1 million. I'm going to consider putting it with Sage to invest. What does that look like?
Yeah, so you become a shareholder of Sage, so you own a piece of all of our assets. So right now, as you mentioned, we've got about 2,400 units in the portfolio that are in various stages of either being stabilized or, in active renovation. So as an investor, there's two ways that investors make money with Sage as an investor in our fund. The first is through the quarterly distribution. So we target that at 6% of our share price annually. So 6%, but those pay 6% annualized, paid quarterly. And then the second component of the way investors make money is in the increase of the share price itself. So each year we go through an appraisal process and revaluation of the portfolio in Q4, and then we adjust our share price at the beginning of the following year. So, this in 2024, our share price was $1.50 per share. In 2025, our share price will be $1.68 per share. So investors coming in this year will be buying shares of Sage at $1.68, and then they would have the benefits of those quarterly distributions and then the increase in the share price over time. And we ask for a minimum 5-year commitment from our investors, and then they have the right to redeem those shares.
Okay, so we break that down a little bit. I'll start with the reverse. Okay, so $1.50 to $1.68. If I did the math, I took 1.68 by 1.5. Is that 12%? Did I do that right?
That's right.
Okay. So if I put $1 million in, let's say I had put it in January 1 of 2024. Let's just say hypothetically, right? Mm-hmm. I put $1 million in. I got $60,000 of cash flow.
That's right.
And I got paid out quarterly. Mm-hmm. Right, so I take 60,000 and divide it by 4, so I get paid out about 15,000 per quarter. Okay, and then I look up, and boom, it gets reassessed at 1.68. So does my million? Do I take that by my shares? It's now 120,000. So it's 1.12. 1.12, right? 1.12. So 1.12. Now at this point, if I say I just want to stay in, then I would take it would be 6% on that. Am I doing this correctly?
That's our target. Yeah, it's not a preferred return. It's a targeted return. We've been paying at or above that since we started paying distributions.
Okay, so assuming that you hit the target, that's 67,200 divided by 4. It's about 16,800 per quarter. Am I doing that correctly?
You're doing the math right.
Okay. Now, what if I say, oh man, I made my 12%. I want to cash out, Ryan. Can I cash out my $1,120,000, or what does that look like?
It's a 5-year minimum commitment.
Okay.
At which point after that you could redeem.
Okay, so 5-year minimum commitment. Got it. And then the averages over the last 5 years would have been like this. Let's say it's 12% for 2025. What have been the averages for the last 5 years?
Yeah, so 22% is the average annualized. I can pull up the numbers for you.
Okay. While you're thinking about that, I want everyone to consider, if you're interested, to go to their website, which I'm going to pull up right now as we talk about here as well. That is sageinvestment.group, sageinvestment.group. Ryan Sudeck, we're talking with here, spelled Sudeck. Okay, so you're going to get that. 5-year minimum commitment. There's got to be some K1 and some offset on taxes. Are you typically offsetting all of that, 6% payout? Is it coming out as basically tax deferred because it's offset by depreciation?
So for the life of our fund, certainly, can't make any promises, but for the life of our fund, we, our investors haven't had any, taxable consequences. They haven't had to pay tax. So we do cost segregation studies. These heavy development projects have a really large depreciation expense that gets spun off of them when they get placed in service. So we take advantage of, all the opportunities that the IRS provides for us to depreciate, to accelerate that depreciation. That all gets passed through pro rata to our investors. Some folks ask me to forecast what that could be. I hesitate to do that because it's such a complicated equation. I'll tell you, for the last 3 years, we haven't done 24 yet, but the last 3 years, if someone put in $100K, they would have seen, a negative, $25K net rental income loss in year one. And obviously there's continued losses. I expect that to be a bit higher for 24, just because we delivered more projects to market. And that's when we get to take that depreciation expense.
Okay, perfect. That makes sense. That's tax flow, not just cash flow here. It's always important.
That's right.
Hey, Ryan, so do you have the numbers maybe just for the last 2 years?
Yeah. So this past year in 2024, the average or the annualized return was 18%, and in 2023 it was 11%, including the share price increase.
Yeah, nice. So if you got in a couple of years ago, you got 11% bump, and then you get another 18% bump, and then this last year you get about
so much of the value comes from when we complete the projects, and so you mentioned total assets under management. The fund's worth about 295. Once stabilized, it's quite a bit higher than that. And we don't take credit. The share price doesn't increase until the project's actually completed, right?
That makes sense. Yeah, either a cash out refi or some kind of sale, right? Where you could justify
or just even stabilized period, right?
Okay.
Because we have what we paid for it, the construction costs, and then we got to fill it up, and then it's worth a lot more, right? Because we talked about earlier, just how the arbitrage between hotel valuations and apartment valuations.
Yeah. Okay. This is making sense. Yeah. No, I like it. And any live deal where you're we got one right now and this is what we like about it. Anything that's you want to share?
Yeah, there's, we've got probably about 15 or so that are in the hopper for this year. There's one that we like that's just down the street from 2 other properties that we own in Fife, Washington. It's right near the port of Tacoma, which is a major employer in the area. And we own an 81 unit and a 96 unit, and we're under contract on a 186 unit property just down the street. It's within a quarter mile. And why we're so excited about it is that we're coming in at a basis that's about $20,000 less per unit than when we purchased those other properties just 2.5 years ago. So I'm really excited. We know the market really well. Rents have been, increasing dramatically. Actually, the U.S. Department of Housing and Urban Development puts out their assessment of fair market rents for zip codes across the country. For that zip code last year, they said that studio rents, and this is the government telling us, studio rents increased by 23%. So if you're on Section 8 or a voucher program, that's the rate at which, those programs pay out. And so just a good indication of the strength of the market there. So really excited to be coming in at a lower basis, looking to acquire that property probably in the second quarter of this year.
Phenomenal. We're speaking with Ryan Sudeck, and you can find him by going to sageinvestment.group, sageinvestment.group. Okay, so let's shift a little bit. Before the show, we were geeking out a little bit about capital gains taxes and ways to unlock capital to be able to bring it to these types of opportunities to help with the affordable housing crisis, but also to get excellent returns and diversify, right? So, I think the question was, what kind of assets can come into these types of, real estate funds? And for the longest time, and our good friend at DLP Capital, Don Winter, and their team, they would have challenges with capital that's coming from business sales and, Bitcoin sales and stock and even invest in real estate. It's very difficult and challenging to do any kind of tax deferred unless it's coming from a retirement account from a big exit. So we've solved that here at Capital Gains Tax Solutions by using a tax strategy, which is a trust with an installment sale, and it allows you to do any asset of any kind. So Ryan, you've been learning about this for the first time, but for maybe our listeners or maybe someone you're sharing this with, to me, this is a game changer, right? Like someone could be, have huge stock and huge, Bitcoin or business or even real estate. They want to get into hotel fund, but they don't have that bridge before the capital gains tax dates hit.
Yeah, we run into this all the time. And, it wasn't until I met you in Asheville that I even learned what, this deferred sales trust even was. And it just seems like a total game changer. When we're talking to investors, who've sitting on a bunch of tech, we're here in Seattle. We got a lot of Amazon, Microsoft investors. Sometimes usually they're borrowing against those shares, even though they might not want to continue holding them, but they don't want to pay the capital gains, right? And so this just seems like such a fantastic tool to be able to not get that liquidity, but also to diversify.
Yeah, 100%. If people want to learn more about this, you can go to capitalgainstaxsolutions.com. We also have a book that we wrote. It's called Building a Capital Gains Tax Exit Plan. And actually, funny enough, Don Winter's actually in the book too, and with DLP Capital, also Kevin Harrington from Shark Tank. And they share their thoughts on building businesses, investing in multifamily. And I share my story about how we've built and help people build capital gains tax exit plans and capital gains tax solutions, our company, because it's such a big problem, right? People want to have diversification. They want to be able to sell their Bitcoin, their business, their real estate. And if that's you, or if you know someone who you could share this with, please do, because it can unlock the capital to get more freedom and impact and diversify while deferring that capital gains taxes. Go to capitalgainstaxsolutions.com. That being said, Ryan, are you ready for the lightning round?
I'm ready. Let's go.
All right. Knowing what you know now, if you could go back to your 20-year-old self and you're at Stanford, you're rocking and rolling, what's the one gold nugget to make sure you tell yourself to do?
Ooh. Say stay humble and stay in touch with folks that mean a lot to you. I think relationships are the most important thing in life.
Love it. Question number 2, what's the number one book you've recommended or gifted the most in the past year?
Ooh. It is actually Don's book, Building a Business. Wow, I'm blanking on the title.
Building an Elite Organization?
Building an Elite Organization. I've got like 3 copies sitting on my desk right now that I've been handing out.
Yeah, it is an amazing book. If you don't have that book, buy the book, Building an Elite Organization. He also has a second one, Building an Elite Career for your team members as well. Really cool. Yeah. Excellent. Question number 3, what are you most curious about right now?
How we can better work with governments to make more affordable housing. It is a really hard thing to get permits through, and there's a lot of barriers. And all of us know that this is a problem. And I'm just looking for ways that we can make it easier on everyone, because we ultimately want to get to the same goal, which is that everyone in this country can have a clean, affordable place to live and call home.
Awesome. Love that. Love the heart for that. Next question. Number one leadership quote or theme that you strive to live by?
Success isn't leased, it's owned, and rent is due every day.
I think success is never owned. It's only rented, and the rent is due every day. Yeah. It's by a gentleman named Rory Baden. I'm a part of one of Rory's masterminds. Incredible, by the way. I love Rory.
I thought it was JJ Watt that said it first, the football player.
I have a feeling that JJ got it from Rory. And maybe that's why it's a little bit out of sorts there. But be that as it may, JJ Watt, Rory, big people.
It probably was Rory, but I only know this because I try to look up the source quote because someone else asked me that question the other day for a print publication, and I went deep and I attributed it to JJ. I guess we got to get Rory's name attached to it more.
I'll find out. Next time I see him, I will definitely ask him that. It's a controversy going on. Right on. Okay, so that's I love that quote. I also apply that. So success is never owned; it's only rented. The rent is due every day. You can actually change the word success, right? Mm-hmm. For example, integrity is never owned; it's only rented, and the rent is due every day, right? You could even say quality, healthy relationships with your spouse or back to the friends, the people you want to connect with. It's never owned. It's only rented. The rent is due every day. Now, obviously, you can't. Certain things you got to be every single day, but other things could be at least once a quarter check in with a friend, or once half of the year, whatever. Plant that there. Just realize that you can't take for granted what was yesterday, right? You can have integrity for 25 years, 30 years, 40 years, and then in one poor decision, you can lose your integrity. So it's never owned. It's only rented. It's due every single day. Okay, awesome. What's the number one way you're using ChatGPT?
Oh man, as a brainstorming buddy, I mean, I use it all the time. There isn't just one way. Really, even when I'm starting with contracts, before I send it to a lawyer, I get a draft together, and I think it saves on legal costs because it takes less time. Communication, but I'm also using AI in other areas too, not just like the ChatGPT functionality.
Yeah, I mean, share anything that comes to mind that's like very helpful.
So like maybe like three that come to mind. One, I use Superhuman as an email client, which has changed my world. It's like the number one tool that I recommend to folks. They've got some really great integrated like email drafting that's like still personalized and mimics your tone. Another is just recording meetings and, the auto generation of like action items and just managing that workflow. I use Fathom Video for that. And another thing that I've been tinkering with, so I used to be in technology, and there's a company out called Lovable, which is basically a software engineer in a box. So you can use it like ChatGPT to create websites and web applications. You could prompt it and say, build me a website. I'm an author. I built a new book. Like, build me a landing page for my book. And in the course of about 2 minutes, it will design beautifully elegant, functional design of the website, but it can go so much beyond that. So I've been playing with that on the weekends a little bit. I think it's one of the fastest growing companies of all time. Just launched a couple months ago, like 2 months ago.
Oh, I'm blown away. I'm going to check it out. Like, I'm excited about that. Wow. Okay. Superhuman, Fathom, and Lovable. Okay.
Yeah.
Phenomenal. Anything else that I haven't asked? You know what I mean? I'll just throw this out. You can ask yourself the question and answer it. Like, anything you're like, I wish you would ask me that, and then we can wrap it up.
I think we've hit on a lot of the key points. I think we hit on the opportunities with hotel conversion space. Hit on some of the risks. Hit on the market opportunity. Hit on the fund returns. I'm trying to think if there's anything else. We hit on the community impact. I think we got most things.
I think we're good. I think we're going to wrap it up. So this is the last question here, Ryan. I want to first of all thank you for being on the show. Thank you for sharing your expertise. Sharing your heart and making an impact in communities. I want to encourage you to keep doing that. Help with this affordable housing crisis. We need all hands on deck to help to do this. And you're doing it in a unique way with excellent returns and a great track record. So thank you so much. Here's the last question for you, and we can wrap it up and also remind people where they can find you. So after all your success helping all the people you've helped, how do you best practice, keeping a stewardship mindset versus ownership, and also stay centered in your values to keep charging forward? Yeah.
I think I seek out opportunities to mentor when possible. So whether that's, I find it with, college students, so both from the school that I went to, participating in some mentorship programs there, but also, with other students in the greater Seattle area. It's weird to be, I still feel like I'm pretty young. I guess I've got some experience now. And so, I love the question about, what would you tell your 20-year-old self? And I find those just to be the most rewarding conversations that I had. Just had lunch with a guy who's about to graduate from college, and the notes afterwards and just the relationship building there. You feel like you're making an impact because life has a series of choices, right? And we have so many paths that we walk down, and you and we've walked down more paths than that 22-year-old, and my mind gets excited for all the different paths that he'll be able to take, and maybe, with some level of influence from the conversations that we had together.
Awesome, Ryan. What a great way to wrap up the show. And for our listeners who want to get in touch with you, would you remind them one last time, what's the best place for them to find you?
Yeah, you can email me, ryan@sageinvestment.group, or you can go to our website, sageinvestment.group.
Awesome. Thanks, Ryan, for being on the show. Also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channel. And we're here to bring on some of the most successful entrepreneurs, millionaires, and billionaires that share their values, their secrets, their insights, their niche specialties like Ryan did today with hotel conversions to multifamily, and ultimately help you get an edge or a thought on investing. And so we're on this journey with you, and we want to help you to scale from millions to billions so you can give more all over a way to help MVPs. I want you to take action today. If you're interested and want to learn more about what Ryan's doing, go make sure to check out the website with Sage. And if you're also looking at a huge capital gains tax, $1 million+ exit, then you want to go to capitalgainstaxsolutions.com, pick up the book, Building a Capital Gains Tax Exit Plan. You need to plan these before you close, because if not, then it's too late. So we've got to set this up. We can also save a failed 1031 exchange. And you want with us on to set up a best 1031 exit plan to have a 1031. So, but everything else you need to set up before close of escrow. So check out capitalgainstaxsolutions.com to get started today. Appreciate you watching or listening to this today. Please rate, review, subscribe, and we'll talk to everyone again real soon. Bye now.